All right, good morning, everyone. Welcome back for those returning volunteers, for those brand new to the program. Welcome to the VITA program. What we'll be doing over the next couple weeks is going over a little bit more detail of the tax law, basically so you're up and ready to go for the upcoming tax season, and wanted to, again, make sure that you have information ready for you not only get your certification, but to also reference back during the tax season process. So one of the first things we're going to be talking about with returns is obviously who needs to file a return. Right, so we can't really prepare returns unless we understand the whole concept of what is the IRS looking for in terms of individuals to be required to file an income tax return. What we have here is a chart from A1 of your 4012. Again, we'll just go ahead and reference this information. There are three things that we need to be able to determine in order to see whether or not a taxpayer is required to file an income tax with the IRS. First thing we need to take a look at is age. Now, that's the only other personal information we need. We don't need to know their height, their weight, their any other favorite password, anything like that. We do need to get their age. That's going to be helpful in determining their filing status. Also, their relationship status. We'll be talking a little bit about these. We'll talk about each 5 of these in just a little bit, but we have to understand what filing status they're going to be using for the return. And the third item that we need is their gross income. And the gross income is going to be determined upon, do they actually have enough income that would require them to file an income tax return? So if we take a look at the chart here, the first filing status we'll see is a single filing status. And we'll talk a little bit more about each of these filing status in just a little bit. But you'll see that there's 2 different classifications, an under 65 and a 65 or older. What you'll see is on the far right-hand column is a gross income threshold. So the gross income threshold is actually our standard deduction for the 2019 tax year. So if your gross income falls underneath the standard deduction, you would theoretically have no taxable income and would not be required to file an income tax return. So we'll see that these things change based on your filing status and your age. As you can see, under 65 is $12,200. Once you turn 65 or older, or have a blind exemption, that actually goes up another to $13,850. So that will change based on a couple other status you may have. Once we take a look at married filing jointly, that's actually going to be twice the amount of a single individual. You'll see a couple other things that occur there as well. Each additional party who is age 65 or older will get an additional $1,300 standard deduction. And then we'll just take a look through that for the rest of the filing status. The one thing to keep in mind, if someone's married filing separately, that age doesn't matter. And the filing status is relatively low, $5. So if they've made $5 somewhere throughout the year and they're filing separately, we may need to take a look and see whether or not they're required to file an income tax return. And the reason that this occurs is because if you're married filing separately and your spouse itemizes their deductions, you are required to itemize your deductions as well, even if you have no deductions to itemize. Meaning $5 is the threshold that would put you to $1 worth of liability. So married filing separately, you'll hear many times today why that's probably not the best filing status to use. And this is one of those reasons. So this chart basically gives a quick overview of who is required to file. One of the things you may find when people find out that you work with the volunteer income tax preparation service, they say, oh, great, I have a bunch of tax questions for you, which is always fun to get, particularly as we hit the holidays, right? A couple big holidays coming up in the next few weeks. People start asking questions. They may say, do I need to file an income tax return? You can go ahead and pull this chart out and go through and determine whether or not they need to file. I never memorize numbers for tax purposes. I'll just be pretty straightforward because that changes each and every year. So it doesn't help if you say, oh, I know the number is 12,000. Well, it was last year, but it's not for 2019. So these numbers are constantly going to be changing as we take a look at cost of living increase and other changes by the IRS. So just as a quick example, if we use the chart and you had someone named Bob, 27 years old, single individual, has gross income of $19,800. They say, should I file my income tax return this year? What would your answer be? Yes, absolutely. You're over the gross income threshold. How about if you have Janet and Henry, who are married? They're going to file jointly this year. She is 67, he is 65, and their gross income was $19,800. They're not required to file. So they would not necessarily need to file an income tax return, but we'll talk about a couple situations where they might need to. Last situation we have is Juanita, who has a dependent child. She is a qualifying widow. She is 47 years old, and she has gross income of $26,000. Yes, she would need to file as well. So what the charts are basically going to help us do is to determine whether or not an individual has a filing requirement with the IRS. Now, on top of that, in addition to these charts, there may be some other circumstances why an individual may have to file an income tax return, even if they don't meet those filing thresholds. And a couple of those that are going to be applicable, first one we're going to take a look at is self-employment income. So if someone has net self-employment income equal to or greater than $400, they will be subject to self-employment taxes and will have to file an individual income tax return, irrespective if they don't have the other gross income meeting those thresholds. One thing to keep in mind, the self-employment income is actually an advanced topic, which we'll talk about later in the season, but we're seeing a lot more individuals who have these side occupations. We're seeing a lot more of what we call the gig economy. People who might be driving for Lyft or Uber, people who might be doing some other side work. So we may be seeing a lot more of self-employment income that they're still going to fall within VITA scope, but they would still need to file an income tax return if they have self-employment income equal to or greater than $400. A couple of the other things that we'll typically see within VITA would be if an individual has taken a distribution from a retirement plan early. Even if they may not have hit the income threshold based on this withdrawal, they still need to report that income to the Internal Revenue Service. A couple other things might be if they have recapture of certain credits. A couple of years ago, we've had a first-time homebuyer credit that is repaid over a period of 15 years. We're still not quite more than halfway through that at this point. We still have quite a few years to go on that. So an individual may need to repay part of a credit that they had taken in a prior year, so they need to file each and every year. One of the last ones we see, and this is why we have it bolded in blue and underlined, just to call it out to your attention. If an individual has gone on the marketplace to go get health insurance and they received an advanced premium credit, which is one of the main reasons why you would go on the marketplace to take advantage of the health insurance, you have to file an income tax return. If you took the marketplace credit, you must file an income tax return each and every year. So there's no exception to that. We'll talk about that when we get to the affordable care section of our training. That's going to be a Form 1095A. If that shows up with the client documents, they must file an income tax return. Okay, so then we get to the part saying, now that we know who has to file, who should file. And this chart will be chart D of your 4012 on page A3. The basic premise here is everyone should file, right? We want to keep busy this tax season, make sure we get plenty of preparation. Everyone can file. You don't have to not file. I hate using double negatives, but you'll see this come up quite a bit with the IRS, but everyone can file. There's no problem for filing a return. We file electronically. It does not take up any time in their system. A couple things we're going to take a look at. If you are expecting a refund, you have to file an income tax return. The IRS will not automatically just send you a check. You have to go ahead and request one from them. So if you have any type of withholding, made any estimated tax payment, or had any other type of carryover credit, you must file an income tax return in order to get that refund. Also, if you had any sale of property and you had a Form 1099-B, which would be from a sale of stock or security, or if you had a property sale, doesn't happen all the time, but every once in a while, a property sale will be generating a 1099-S, which is for a sale of a residence. If the transaction is your primary residence, typically an individual will not get a 1099-S. It's more so for any type of rental or commercial property. But if a 1099-S is received by a client, they must file an income tax return. Otherwise, the government feels all the money that they received is all taxable income, and they'll give them a nice little letter in a couple months and ask for a lot of money back. So we want to be sure that we get these 1099-S's and 1099-B's in the return. The other thing that we take a look at, one of the most important reasons is to be able to generate refunds. We may see that a lot of our individuals coming into VITA are qualifying for specific refunds that they can only get by filing an income tax return. The biggest ones we'll see are going to be our earned income credit. We're also going to see the additional child credit, the American Opportunity Credit. Those are some federal credits that are actually refundable. So even if you don't have any tax liability, you can actually get additional monies back. So even though an individual may not owe anything to the IRS, they did not have anything withheld, they can still get a refund back. And one of the other issues that we'd see would be for individuals who are seniors or otherwise qualify for the PA property tax or rent rebate program. So they may not have a federal liability, but they may want to come into our program to file for the PA rent rebate claim. All right, So one of the things we're going to take a look at here is, fortunately for 2019, we are not seeing any major changes from the prior year. The only thing we're seeing are some numbers changing from the prior year. Again, in 2018, it was a $12,000 standard deduction, which was pretty easy to memorize. Now it's $12,200. But there's no changes to a couple other rules. You may have recalled, if you had filed your returns in the past, we had an item called exemptions. So personal exemptions had been on returns prior to 2018. That is eliminated now. Theoretically, till 2025, or until Congress changes their mind and changes it sooner, as tax laws are never fully permanent, we'll just keep rolling with these rules until we're told otherwise. But these are suspended until after 2025. Now, you may say, okay, well, we don't have to worry about exemptions anymore, so these returns are a lot easier, right? Well, in some ways they are, but we still need to take a look at areas of dependency, because dependents may help determine whether or not individuals are eligible to be claimed on a return. And if they're claimed on a return, that may actually give a taxpayer some additional credits. And we'll talk about those a little bit as we talk about dependency, but then we'll have a whole other section that talks specifically about credits. So kind of talking about what we mean about a dependent. So even though we don't have personal exemptions anymore, we still want to be sure we're reporting the appropriate amount of dependents on a tax return. And this will be referenced in your C1 of your 4012. Now, when we take a look at a dependent, what we're looking at here is we are not allowed to take any dependents on our return if we ourselves can be claimed as a dependent on someone else's return. So theoretically, if you have a situation where you may have multiple generations living under one roof, and you have a younger parent who has a very small child, all living under the roof of a kind of try and come up with a better example here. So we have a grandparent, a parent, and a small child. If they're all living in the grandparent's home, and the parent wants to take a dependency on their return for their small child, they cannot go ahead and have another dependency as well. So what we have to watch is that we don't have a situation where, if you are eligible to be claimed on a return, so if the parent is eligible to be claimed on the grandparent's return, they cannot take a dependency themselves. So if you're eligible to be claimed as a dependent, you may not take any for yourself. We probably won't walk into this too much during the tax season, but I just want you to be aware when you take your test for VITA certification, they every once in a while throw a little tricky question out there for you. So just keep in mind, if you yourself could be claimed, not whether or not you're actually being claimed or not, if you could be claimed as a dependent by another person, you may not take any dependents for yourself. A couple other rules for dependency. So the person who's being claimed as a dependent must be unmarried, or if they're married, they cannot file a joint return. But if they're married and they file a joint return, it's only for the purpose of getting a refund. So one of the things you'll find quickly about tax law is there'll be a rule, then there'll be an exception, then there'll be an exception to that exception, and then they'll give you some definition that doesn't really make a lot of sense, which is why we try and clarify it here for you. But in general, the dependent cannot be married. So that's one of the first things we take a look at. The other area we take a look at is they have to be a US citizen, a US resident alien, a US national, or that they'd be a resident of Canada or Mexico. So as long as they're in North America, they're resident in those countries, they can still be claimed as a dependent. Now, there are a couple special situations when we have an adoption. So if we have someone who is going through an adoption process, it becomes a little bit more involved of claiming a dependency exemption, but you still can claim an adopted child, even though they may not have met the residency or the citizenship test yet. Now, when we talk about the dependency, we're going to fall into one of two categories. We're either going to have a qualifying child or a qualifying relative. The first one we're going to talk about is a qualifying child. This is our principal status. So the first test we're always going to walk through is to see whether or not someone is considered a qualifying child. And if they are, then that means that that's the only status that they can have. So we always want to test first for a qualifying child. And there are a couple rules that we take a look at. And those are as well detailed in your 4012 on C1. One of the interesting parts we're going to see is the IRS is going to use the same word and come up with multiple definitions for what we consider a child. Now, in our own minds, if someone just says, oh, I'm going to, what does a child mean to you? Whatever you want to come up with is not the same definition the IRS has. I'll just let you know that right now. According to the IRS, a child would be either a child, stepchild, okay, pretty good so far, a brother or a sister, now it's getting a little weird, A half brother, half sister, step brother, step sister, or descendant of any of them. So I think we were okay on the first one, right? We understand a child is your actual son or your daughter, but now we talk about your brother and your sister, which is usually not biologically possible. But what we're going to take a look at is the IRS has a specific rule to say you can actually claim your brothers and sisters in certain circumstances. There may be a situation where you have now become a head of the household. Perhaps the parents aren't around and you're caring for a younger sibling. And that can be very possible. And they allow you to now take a dependency exemption for your brother or your sister. And we'll talk about some of the additional rules that we have there for qualifying child. Now, it also means any descendants of your brothers and sisters. So your nephews, your nieces, your grandnephews, your grandnieces, your grandchildren are also considered child for purpose of the dependency exemption. Adopted children and qualified foster children also count for this definition as well. Now, there are a couple other rules that we have to take a look at. One is going to be an age test. So we'll talk about the way the IRS talks about age, and age is always going to be a bit unique. So I want you to refer back to the charts. Again, even though we'll probably have an understanding of how these terms work out, they'll change the way in which they define things. Sometimes they'll say you have to be under a certain age, or they'll just mention an age, or they'll say something an age and a half. But we'll try and make this as clear as possible for you to go through the process. The first thing we're going to take a look at is, in order to be a qualifying child, you have to be younger than the taxpayer. And you're going to say, again, this doesn't make sense. How do you have to be younger than the taxpayer? Okay, it doesn't make sense for your child to be younger than you, right? I mean, they're naturally going to be younger than you, except maybe some weird kind of step situations. But what they're looking at here, this is that brother or sister context. So your brother or sister has to be younger than you in order for you to claim them as a dependent. So if you're caring for an older sibling, they will not be considered a dependent unless they meet the last qualification, which is totally or permanently disabled. So the child has to be younger than the taxpayer and either under the age of 19. So we say under the age of 19, but I think those of us who are good at math realize that's 18 or under, right? So under 19 means 18 years or younger would be the qualifying child. Now, if they're a full-time student, they can actually be under the age of 24. And here we have another definition, full-time student. So again, if we ask what your definition of full-time would be, it's probably not the same thing the IRS is going to mention. So for a full-time student, what the IRS says is you need to be a student for any part of 5 months out of the year, which sounds a lot less than full-time. You also don't need to technically be a full-time load. You at least have to be at least half-time under the criteria for the college institution. So it doesn't mean that you are taking the maximum amount of credits each semester and you have to be in school for the entire year or even 2 semesters. It's just any part of 5 months, which generally works out because most colleges for a spring semester will have you go to school in January and generally graduate by May. They're not full months, but they count for any part of those months. So that's still considered a full-time student. And the third criteria that I referenced before was the child can be any age if they're basically a totally and permanently disabled. So I've worked with an individual before where he has a sister who has some mental and emotional needs. She is older than he is, but she is still considered his dependent because she's totally and permanently disabled. So she's still eligible to be claimed as a dependent on his return. So if they do have a total or permanent disability, they can be claimed as a dependent. So they don't have to be younger than the taxpayer in that case, as long as they meet the other qualifications. Now, in addition to the age test and the relationship test, we have a couple other things we need to look at. They have to live with the taxpayer for more than half the year, so they have to be in your home for more than half the year. What's an interesting part here is they could not have provided more than half their own support. The government doesn't care where their support came from as long as it didn't come from the child. So it doesn't have to be the taxpayer has to provide more than half their support. It's just that the child could not have provided more than half their support. And when we take a look at support, it's only if the child, if they have earned money, if that money was used for their own support by themselves. If they've earned money and that money was set aside for things like a college savings account, or maybe they were just putting it away for other purposes, that's not considered for their own support. So someone else is still supporting them. A question that we sometimes get would be if a child's eligible for Social Security Administration benefits. So if they're getting SSA, that money will be considered for their own support only if it's being used by the child for their own support. Again, if the SSA money is being used and set aside for other purposes, which technically it's not supposed to be, but if they set it aside for other purposes, it's not considered the child providing their own support. Other support from the state or other welfare agencies is not considered support from the child. So the only one we have to be concerned about is the SSA. So any support coming from a state or other program is not considered support from the child. So that would not disqualify them. Other question we have here is they cannot file a joint return, which if you have a 5-year-old child, it's probably a good thing they're not filing a joint return. If they are, they can still be claimed as dependent as long as they're only filing a joint return to get a refund with their spouse. The one situation we may see this in a little bit more is probably the most common example would be individuals who may be joining the military, coming right out of high school, and they decide to get married. The child is still living with their parents while the other spouse is serving in the military. They are jointly filing a return. They're filing a return, only get a refund back. So the child still living at home could still be considered dependent of their parents, as long as the only reason they filed jointly was to get a refund back. And we're also going to take a look at another situation here. When we take a look at this definition, there may be multiple people who would have an opportunity to claim a child as a dependent. Yeah, the rules are relatively kind of broad in terms of who can be claimed as a child. That relationship test is very, very general. The child just has not, cannot provide more than half their support, and as long as they share the same household with the taxpayer, a lot of people could be eligible to claim a child as a dependent. So the IRS has come up with a tie-breaking situation. So what we want to take a look at next is on our next chart, which is also replicated in C2 of your 4012, which would be our child tie-breaking rules. So when we take a look at the situation, we may have, again, multiple people who can claim a child. And as we think back to Becky's example this morning, the reason why the grandmother ran into issues with the IRS is because someone else tried to claim the children as dependents on their return. So the situation she was talking about this morning is exactly what we're looking at here with this tie-breaking chart. So if a child can be claimed by more than one individual, and only one of the individuals is the child's parent, the tie-breaking rule generally will go to the parent. So the IRS will say, if we have an aunt, a grandmother, and a parent all trying to claim a child on the return, we're going to give the dependency exemption to the parent. Now, that's a rebuttable presumption, but that's generally the tie-breaking rule. So the second situation would be if both people trying to claim the child are parents, and they have to put in here that they're not married filing jointly, which it would show up on the exact same return. I'm not quite sure why they need to make that clarification for us, but I'm glad they wasted some ink and did that. What we're looking at are situations where you may have parents who are no longer married or maybe married filing separately, and they're both trying to claim a child. The IRS will go to determine who the child had spent the greater portion of the year. So if both people trying to claim the child are parents, they're going to go with a custody. Who had the greatest amount of custody for the period of time? And we go to the next situation to say, all right, well, both parents, again, as long as they don't file jointly. So, you know, we said it the first time, we'll say it again just because it makes it a little bit clearer. If both parents claim the child and the qualifying child somehow spent the exact same amount of time with both parents, that we counted up all the days and they came up exactly the same, then the next rule we go to is whichever parent had the highest amount of adjusted gross income. So it's going to go to the parent with the highest, what we call AGI. Now, we'll go through a couple of these areas and we'll tell you why you may not need to worry about this too much other than for testing purposes. If no parent's going to claim the child as a qualifying child, and again, we have a situation where we may have a grandparent, an aunt, a sibling trying to claim the child, the default position is it's going to go to highest AGI. Now, the last situation is if a parent could claim the child, but they choose not to. And this may be a situation where there might be a variety of reasons. The parent may not have enough income that it makes sense for them to even file a return. There may be some other situations where they may not fully have custody of the child due to incarceration or other issues. Then the individual with the highest AGI may claim that child, as long as their AGI is higher than the parent. So again, we kind of default back to this AGI scenario. Now we go through this chart and a lot of great information here. Best part, we probably won't use it all that often within VITA, other than for your certification when they ask who's eligible to claim the child as a dependent. In most cases, when we walk through the practice here, and I think Michelle will be talking a little bit more about kind of going through some questions at the end of the session here, How do we determine who's a qualifying dependent of an individual? And we'll go through a series of questions. We'll use the flow chart. We'll use the decision trees. We'll use that interview context to determine who's actually eligible to be claimed as a dependent. One of the areas we take a look at, the IRS is very good on determining who the first one is to file a return with a dependent. Not quite sure if anyone here has ever had a case where you filed a return, you get a reject notice because it comes back to say, oh, by the way, the dependent you claimed has already been claimed on someone else's return. But the situation we run into then is we go back and we kind of verify with everyone who's eligible to claim, and then we get to the situation where we let the IRS sort it out. We'll file a paper return, and then both parties get a notice from the IRS, and then we go through the flow chart again and determine who is actually the proper one to take that dependency exemption. So it does give us an opportunity to kind of review things. We want to be sure that we have the best situation for our clients and we're following the IRS prescribed rules, but all the information you need to claim dependency exemption will be found in your 4012. Okay, so moving on to the next scenario. If the individual does not meet the qualifying child rules and not a qualifying child of anyone, then we're going to move on to a qualifying relative. And if you thought the definition for child was a little odd, just wait till we get to qualifying relative. So the qualifying child rule always is going to take precedence over qualifying relative. If someone meets the qualifying child rule, they do not become a qualifying relative. You can't kind of pass that test and go directly here. Now, one of the unique parts, and I kind of changed this around a little bit just to kind of show the unique aspects of the IRS. So qualifying relative. The first definition that we're going to talk about is someone who's not even related to you. So if we take a look at the points here, we have the first one is that they're not a taxpayer or anyone else's qualifying child. The next piece is that they live with the taxpayer all year long as a member of their household. Well, that could be anybody. That could be your neighbor coming in. That could be a friend of yours living on your couch for the entire year. They don't even have to be related to you, but they meet the definition of a qualifying relative. Now, one of the downsides we have here is these tests go a little bit backwards. I'd like to see kind of us talk about the gross income test first, because if people get all excited to say, oh, tell me more about this qualifying relative. So anyone I know that's lived in my house for part of the year can be dependent? Well, not exactly. So the first thing we take a look at is the qualifying relative test. Someone who's not even related to you, but they stay in your house for the entire year. So when we mean entire, the IRS is pretty clear on this. It's the entire year, January 1st through December 31st. So just as a little personal note, if you have someone staying in your house right now who's been there since January 1st, and you're thinking it's about time that they move on, you may want to give them till the end of the year. Just kind of January 1st, let them have some pork and sauerkraut, and then go ahead and tell them to move on, right? So they have to be there by December 31st. Now, they also have to go through a couple other situations as well. They cannot violate local law. So kind of an odd situation would be if you have a individual living with you, if you have a boyfriend or girlfriend living with you all year long, they could be a qualifying dependent if they meet the qualifying relative standpoint, unless they happen to still be currently married to their spouse. Local law may prohibit cohabitation, which means that they would not be considered a dependent. Just another little kind of quirk in the tax rules. Now, so we move off from the person who stays with you who's not even related. So now we'll go back to what the IRS considers related to you. Is anyone ever taken an ancestry DNA tree? It's about the same context we have with the IRS. So when we take a look at what we consider related to you from a IRS perspective, we're going to go back and say, okay, child. Okay, here we go with child again. It's child. It's going to be your stepchild, eligible foster child, grandchild, great-grandchild. I think we're in pretty good shape going down linearly. It can also be your sister, your half-brother, your half-sister, stepbrother, stepsister, father, mother, grandparent, or other direct ancestor. So now we're taking a look at, you take a look at yourself, you go down from your genealogy, anyone who's a descendant of you, anyone who's an ancestor of you, other than a foster parent, and then we work our way outside the chain. So we'll go your brothers and your sisters and then move down from them as well. It also includes stepfathers, stepmothers, stepbrothers, stepsisters, includes all your in-laws as well. So by marriage, these individuals can be related. Sister-in-laws, father-in-laws, mother-in-laws, all are considered in there. The one exception we have, the one area that gets kicked out, are cousins. They're the only ones that don't quite fit into this definition. So everyone else is kind of fine for the most part. But generally, we take a look at your genealogy, And if they fit somewhere in the family tree, again, we'll ask some probing questions. We don't need them to bring in kind of a family Bible or some sort of genealogy tree to show that they actually are related to you. But we take a look at the definition. It's a fairly broad definition here for relationship. Now, a couple other changes that we have here. The one area that we have is that their gross income has got to be under $4,200. So we probably should have started off with this before people get excited and they start taking a look at anyone who possibly could have been related to them. Their gross income has to be under $4,200. It's a relatively low threshold. So as long as it's under $4,200, they could be claimed as a qualifying relative. Now, they cannot have provided more than half their own support. So in the qualifying child rule, the only thing we determined was the child didn't provide half their own support. Now, in this case, we have to take a look and see, did the taxpayer provide more than half the support for the individual they want to claim as a qualifying relative? So now you need to demonstrate that you have provided more than half the support for this individual. So what we want to take a look at here is whether or not that person has provided at least half the support. Now, a couple of things we take a look at. That gross income of $4,200 is relatively low. If someone's working a part-time job, they're probably going to be over the $4,200. Again, if someone's living on your couch and they say, I'm thinking about getting a job and then I'm thinking of moving out. Again, start applying, but don't start till after January 1st. We don't want you to actually have more than $4,200, and then you're going to get kicked out and you can get your own place. But what we take a look at is gross income is going to be considered all money. So any type of property, any type of services that's not exempt from tax. So anything they're doing that's not tax exempt is going to be considered gross income. Now, the good news, tax exempt income, scholarships and inheritance is not considered gross income. So if they're getting a scholarship somewhere, if they're a college student and they're getting a scholarship, that's not gross income. If they've inherited money, that's not gross income. Also, Social Security generally won't hit that threshold. Social Security usually doesn't count unless the individual is married filing separately, or half the benefits plus other gross income and tax exempt income exceeds $25,000. So half their Social Security and tax exempt income exceeds $25,000. Sounds like a pretty decent amount of money, and you probably did not provide more than half their support in that case. So the threshold's relatively low. That's someone earning about $50,000 a year in Social Security benefits, or has a lot of tax exempt income somewhere else. That number bumps up to $32,000 if they're married filing jointly. Again, I just want to kind of point out a couple exceptions to these rules. So someone may say, well, I have a mother living with me. She makes $10,000 in Social Security. She's not going to qualify because she has more than $4,200. Well, interestingly, that's not gross income. We have to go through the gross income test. So parents may qualify as qualifying relatives, particularly if we see parents moving back in with children, or children taking care of their parents somewhere else. Okay, so I think what we'll do is move on to filing status. Okay, we'll keep going. All right. Okay, so one of the things we started off with talking about who needs to file a return. We talked about a couple things. We talked about age. Fortunately, that one's pretty easy to determine. We talked about gross income. It's slightly easy to determine. But then we talked about this thing called filing status. And filing status is going to be helping us to determine what methodology are we going to use to file a return. And as you can see from that chart we started off with, that filing status will determine what type of standard deduction would the taxpayer be eligible for. Now, we do have 5 different types of a filing status. We're going to talk about each one. We kind of go from kind of the basic into a little bit more, go to a little bit more obscure toward the very end, ones that we may not see quite that often. As Jesse mentioned, these are coming right out of the 4012, the B8 and the B9. They sound like vitamins, but they're actually going to be an opportunity here for us to go through a decision tree and then also interview questions to help determine a filing status. So one of the things we're going to first take a look at is the status of single. And again, what we take a look at is understanding the IRS language, what they mean. So what we take a look at is your status as of December 31st, 2019. So we don't care about what happened throughout the rest of the year. It's what happened at the very end of the tax year. So we're only looking at your filing status as of December 31st, 2019. So at the last day of the year, if you were unmarried or legally separated from your spouse under a divorce or separate maintenance agreement, here in Pennsylvania, generally, if you don't have a divorce agreement, you're still considered married until that final document goes through. So we don't have a kind of a separate agreement here. So you're going to be single if you're unmarried at the end of the year and you don't have another filing status to work with. So this is kind of our default. So this isn't a relationship status to say, it's complicated or, we're dating. I don't know how serious it is. If you're not married, you're single. So it's a pretty clear-cut determination. Now, you may have people who say, you ask about kind of their filing status and you say, just wanted to ask, do you have a spouse? Well, unfortunately, my spouse died. I'm so sorry to hear that. When did your spouse die? 1973. All right, if you're a widow or widower and your spouse died before 2019, you're most likely going to be single, unless we have another special exception to qualify you for. So even if you had been married, for IRS purposes, your marriage terminates upon the death of your spouse. So if your spouse died prior to 2019, you're most likely going to be single unless you meet the test for a qualifying widow or widower. Now, when we take a look at the single definition, hopefully that is fairly straightforward. If you're not married at the very end of the year, you're going to be considered single. Now, we're going to move to two different filing status if you are married. So if you are married on the last day of the year, you may file jointly. It's kind of an election. Both you and your spouse have to agree to file jointly. So you can file jointly if you're married and living together. You can file jointly if you're married and living apart, as long as you're not yet divorced. As long as you are separated, but again, we don't have that final divorce decree. If you're in a common law marriage, which we don't have here in PA, you can file married as well. If your spouse died in 2019 and you would have met the qualifications for married filing jointly, you may still file jointly with your spouse for the year of their death, provided that you did not remarry before the end of the year. So if your spouse died in 2019, and you did not remarry, you can still file jointly for 2019. If your spouse died in 2019, you got married 3 days later to someone else, you may not file married jointly with the first spouse. You can file with your second. First one would have to be separate, and the insurance company is probably going to have some questions about the result of that death. But that's what we're kind of taking a look at here. Married filing jointly is an election by both parties. If they're married, they can file together. Same-sex couples are married. So if they are married under any other type of state or any other international law, if they're married in a jurisdiction that recognizes their marriages, they are considered married for federal income tax purposes. They don't have to live in a state that recognizes same-sex marriage, but in most cases, I believe all states here in the US are moving to that way if they haven't already. So in that case, we're going to see that same-sex couples are married individuals. Now, this does not apply if they have not gone through a marriage process. If they're just in a civil union or some other type of relationship, they're not considered married. They have to be married under some jurisdiction that recognizes marriages, whether that's a state or foreign government. Now, one of the things that we take a look at, and this was mentioned a little bit earlier as well by Becky, talking about married filing separately. You don't have to file together with your spouse. There may be situations where people don't want to file together. And on occasion, you may find that coming into VITA that someone says, I'm married, but I don't want to file with my spouse. And you can ask a couple questions as to why, but just bear in mind, we're not relationship experts. We're not here to try and figure out why they don't get along with their spouse or why they don't trust them. But they do have the option to file separately. So if you want to file separately, the main cause we probably hear is that we don't want joint liability, that my spouse owes money and I don't want to have my refund taken away by my spouse, or I don't trust my spouse. Again, that one's probably a longer issue than what we would need to get into for VITA. But if their spouse has self-employment income, or the spouse claims that they have donated all these priceless works of art that you've never seen, and they're taking deductions on the return you're not aware of, might be a reason for you to say, I don't want to file with my spouse. Now, in very limited circumstances, perhaps the married filing separately will give you a less tax overall. But it's a very, 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 very rare circumstance and usually does not apply within VITA. So we don't really see enough change in their filing income to be able to warrant a married filing separately. Now, we still have people who say, I'd like to file separately because my spouse owes child support, my spouse owes back federal taxes, or my spouse is default on student loans. And that's where we have the opportunity to file an innocent spouse provision. So we have a couple different things. We have an innocent spouse, we have an injured spouse. Innocent spouse provision would be one It's a little bit more complex. It's basically when people have a concern that their spouse is putting things on the return that they're not aware of. So an innocent spouse would be that you clearly have no knowledge that your spouse was cheating on the return. And what we take a look at is to say that you have to be completely unaware that there were things that were incorrect. So if you are married to an individual and they are self-employed and they claim that they only make $8,000 a year in self-employment income, but you have a house that's worth over $4 million, you take vacations to Turks and Caicos for about a month at a time, you've never had to cook in your own home even though you have an $80,000 kitchen, it's probably not correct that they only make $8,000 a year, and that you have some knowledge that it's not correct that $8,000 a year will help pay for all of that. So, but an innocent spouse relief provision can come into play. It's something we don't really work with too much in VITA, but it is a great opportunity to refer that over to the Mid-Penn Legal Center if there's an innocent spouse claim, usually as a result from an IRS audit. The one area that we can get into is what we call an injured spouse. And an injured spouse is where you have a situation where a taxpayer's refund may be held by the government because their spouse owes money. Again, child support, past federal tax debt, student loans, something along those lines. What can happen in that context is if you file jointly, the IRS, if there's a refund, will take all the monies and apply it to that outstanding liability. If you file an injured spouse claim, and it's a Form 8379, you can actually split the refund between the two parties. So you can still file jointly, you can still take advantage of all the benefits. But what happens here is that the refund will be split between the two parties. So the spouse who feels that their refund's always been taken by the government can still get money back, and the government can still pursue the other party who owes them money. So it just gives them that opportunity. Another situation that may arise here for VITA purposes, we get it on occasion, the question, are you married? Yes, I am. Where's your spouse information? Well, I don't know, I haven't seen my spouse in decades. Well, the situation is technically you are still married until you can prove that the spouse is dead or you've gone through a divorce process. So you're still technically married. And I believe the VITA position is that we're going to be filing as a married filing separately unless the individual qualifies for another filing status, such as head of household. If you are married but the spouse is estranged and they don't know anything about them, we can still file a return. We have to actually enter a social security number for a married filing separately return. In this case, if we take a look at the slide here, we do have a code that the IRS has provided that we can use, and that return has to be paper filed. But we can still file that if we have a situation where someone has an estranged spouse and they don't have any information on them. Now, we kind of talk about why do we want to file jointly rather than separately, and so we have a number of reasons here. If we file separately, and again, you may have a client that comes in and says, I don't want to file separate, I don't want to file jointly because I'm concerned that my spouse isn't being honest on the returns. I'm concerned that I'm going to lose some refund benefits. And that's the reason why we want to take a look at those innocent and injured spouse provisions, because if we file separately, you're going to lose a lot of benefits. You're going to lose things like earned income credit. One of the main reasons a lot of individuals come in cannot take an earned income credit if you're filing separately. You also cannot take the child care credit. You can't take the adoption credit or any of the education credits. So if you're filing separately, you cannot take any of those credits. You also lose some education benefits. If you have student loan interest, you may not take that as a deduction if you're filing separately. Same thing with savings bond interest. Other thing we take a look at, the reason why the filing threshold was only $5 was if you're married filing separately and your spouse itemizes deductions, you are required to itemize as well. So a bit of a downside, if you don't have any itemized deductions, you don't have any exclusion from income. There's no reduction of your income. So usually you have a much higher threshold. If you have Social Security, if you are retired and collecting Social Security, a much higher percentage of your Social Security is taxed. So normally when we talk about income for Social Security, it's going to be 0 to 85% based on a sliding scale. If you're married filing separately, it goes to 85 very quickly. Other limitations you have would be things like sale of home exclusion has changed. We have some IRA contributions and distribution limitations as well. So generally we try and recommend, if at all possible, file jointly. Even if you don't like your spouse, maybe for 5 minutes you can get together and sign the return just to help the refund out. So a couple things we'll talk about there. And again, we may have some additional examples of how that may come into play in practice. Okay, so we have kind of 3 of the 5 already down. The single, married filing jointly, married filing separately, which we hopefully don't do a whole lot of those. But the next one we take a look at is the one everyone wants to be, head of household. Because it's the nicest sounding one, right? You know, if you have a choice of single or head of household, what do you want to be? Head of household sounds a lot better than single, right? Or married filing jointly. Head of household is a qualifying status. It's going to be a special situation. Now, even though a lot of people want to be head of household, they've heard a lot about this, or friends have taken head of household. They watch daytime talk shows that say head of household is a great status, right? It may not actually be that much more beneficial. Now, I only say that only for the fact that we sometimes have people trying to get themselves in head of household situations that are not actually head of household. So we have to go through and make sure we're doing due diligence on the fact that they're head of household. The other thing I want to mention is just because they had a filing status in the prior year does not guarantee that's going to be their same status they have for the current year. Each year has to stand on its own. So even if they may have met a status before, it doesn't mean that for 2019, we're just going to do the exact same that they had for 2018. So in order to qualify for head of household, you actually have to meet all of these conditions. That the taxpayer has to be a U.S. citizen or a resident for the entire year. So if you have a little bit more of a situation, if we have people coming in, some of our centers have some refugees that come in, they cannot be a head of household unless they were a U.S. citizen or resident for the entire year. You also have to be, at the end of the year, not married, or an interesting term the IRS has created, considered not married. So considered unmarried, we'll talk about in just a little bit, but it's kind of a term you can only use for tax purposes. It's not good for anything else. So don't try and use considered unmarried for anything other than head of household testing here. You have to pay more than half the cost of keeping up a home. So now we're looking at home ownership, that you're providing a place to live, and that home has to be a principal residence for more than half the year for either a qualifying child or a qualifying relative. And there are a couple exceptions that we have. So these definitions get a little bit tighter on what we mean. Now, the thing I dislike is that they use the exact same verbiage to say, do they meet a qualifying child or qualifying relative test? But we're going to start taking a couple things out of there. So a qualifying relative under this case does not meet that friend on your couch scenario. So they are not a qualifying relative for head of household purposes. Now, what we want to take a look at is the whole considered unmarried. So general situation, if you have a single parent, unmarried, living in a home, provide more than half the cost of keeping up the home, child lives with them for more than half the year, that's our quintessential definition of a head of household scenario, right? They are unmarried and providing more than half the cost of the home and have a child in their home for more than half the year. But we have another situation to be if you're considered unmarried. Now, considered unmarried would be that you're filing a separate tax return. Where we see this often is probably in a situation where a couple is going through a divorce process. So they're not officially divorced yet, but they're in the process of being divorced. So if we go back to that definition of married, if you're married on the last day of the year, you're considered married. But we can have a considered unmarried definition. If you have a separate return from your spouse, so you want to file separately, and you paid for more than half the cost of the home, keeping up more than half the cost of the home for the entire tax year, and for the last 6 months of the year, you did not live with your spouse. So we're looking at July 1st through the end of the year, you did not have a cohabitation relationship with your spouse. So whether you moved out or you kicked them out, they were not there for the last 6 months of the year. So it gives you an opportunity for you to otherwise would have been filing a married filing jointly or married filing separately. You can move to a married filing separately status and then convert yourself to a head of household as long as you had provided more than half the cost of the home, lived separately from your spouse for the last 6 months, and you had a qualifying individual living with you. So a home is going to be the main home for at least half the year for your child, stepchild, adopted, or foster child. Now, a grandchild does not meet the qualifications here. So when we're looking at head of household, we only go to the next layer. It's only your child, your stepchild, adopted, or foster child that meets this qualification. So you can't be a grandparent taking care of a child and meet head of household under the considered unmarried piece. So considered unmarried has to be, a child, So again, what we take a look at is kind of the custody issue. So if you have custody of that child for more than 6 months of the year, you are considered the custodial parent. So even if you didn't take a dependency exemption, you may actually get to take a head of household exemption filing status. Now, we may have a situation where you have parents that are going through a divorce and both of them can take a head of household status. This situation can arise if the parents have separated, they're both in their own place, they're both paying more than half the cost of keeping up the home, they have some sort of shared or joint custody arrangement. One parent can take one child, the other parent takes another child, and they can both be considered head of household. Now, a couple other things we take a look at is, if we're talking about head of household, typically there can only be one head of a household. So we'll talk about what this means. One of the definitions we use for head of household is more than half the cost of keeping up a home. So if you take a look at an address, generally only one person can be paying more than half the cost of keeping up that home. So just be cautious if we have multiple people coming in all using the same address and all wanting to be head of household. Only one person's paying more than half the cost. And the IRS is pretty clear on how this definition works. In fact, we have a chart here on B11 of your 4012 that talks about the cost of keeping up your home, including some very nice clip art in the bottom right-hand corner so you know what a house is. What we're looking at is literally anything inside that four walls is considered the cost of keeping up a home. Now, what we take a look at is property taxes. We're going to take a look at mortgage interest expenses. These are things that are typically going to be reported on an income tax return. If you pay rent, if you don't own the home, we take a look at rent. It's going to be utilities, any repairs and maintenance you may have, any property insurance, any food consumed within the home. Now, the definition originally came about because the IRS said, well, obviously groceries make sense. If you go out to eat on occasion, that's not food consumed in the home. I'm not quite sure how we're going to deal with Grubhub and other food delivery services. Technically, they are consumed in the home, so I think we're okay from that scenario. But we want to make sure it's food consumed in the home. So if you're going out to eat, don't bring receipts in from your meals. That doesn't count. It's taking a look at food in the home and other household expenses. What does it take to keep that home together? Now, it does not include things like other support areas we take a look at: clothing, education, medical expenses, any vacation, any personal living costs, any transportation. It's only for the cost of keeping up the home. And when we have a definition to say it has to be more than 50%, the IRS has a very good chart to come up with this, which we'll see on B11 here as well, is they're going to come up with a column to say, let's go ahead and take a look at the amounts that you paid in the center column. And then we're going to take a look at the total amounts of the costs. And we're going to add all those up at the bottom. And your number on your column has to be more than 50% than the total cost. If it is, you have met that qualification. If not, you are not head of household because you did not meet more than 50%. So the caution that we have here is people take a look at that head of household and they think, that's the status I want. You know, I take care of my children. I'm not married or considered unmarried. But if they don't meet the qualifications, if someone else is paying the rent, if they don't meet the qualifications because they're living in someone else's house, we don't want to push them in head of household because they don't qualify. It would be impermissible for us to go ahead and have them as head of household. The IRS is cracking down on the head of household status. They will take a look and see if they can identify whether or not there's any impermissible use of head of household. And again, what we're getting with head of household is really two different areas. One, a higher standard deduction. So you can take a look at the chart on that we had discussed here, and you get a slightly higher standard deduction of head of household. You also get a slightly different tax rate system than you do as a single individual. But in a lot of cases, especially for VITA clients, it may not make that much of a difference in terms of a refund. The main areas we're looking at refunds for VITA clients are coming out of earned income credit or child tax credit, which are not dependent upon filing status. So if there's a question about filing status, again, take a look at the rules. If you still have an issue, I think we probably recommend maybe talking to your site coordinator if you just want to be sure things are working out well. And I think we'll probably hear a couple things from Michelle about that a little bit later on today. But we'll want to talk about filing status. So I just want to give you a quick overview of what the filing status would look like and the options. Again, head of household is going to be our most popular one here. And I think what we want to take a look at is make sure that it does qualify. And we have one other one we want to get to here before questions. Does that work? Okay. Yeah. And the last filing status, so we've been talking about that we have 5, and we spent a good amount of time on the 4th one here, head of household. We have one last one that is pretty powerful. So if you thought head of household was a great status, the qualifying widow or widower with qualifying children is our highest status. Now this one's much more difficult to get into. So it has a couple different criteria. One is that the taxpayer's spouse had to have passed away in 2017 or 2018. So if a taxpayer spouse died in the current year, if they passed away, you can file jointly. If they've passed away in the prior 2 years, you may be eligible to claim the qualifying widow or widower with dependent children. So as long as you were able to file a joint return the year that your spouse had died, you did not remarry before January 1st, 2020, you paid for more than half the cost of keeping up your home, and the home was the main home for the entire year. So it's not more than half the year. We're going to change the definition. It's going to be the entire year for your dependent child or stepchild. Again, this does not include grandchildren and does not include a foster child. So this is specifically for your children or your stepchild. Situation where this may arise is where we have kind of a unanticipated passing of a spouse, and you have a surviving spouse that's still taking care of dependent children. They're still living in the home. They've lived there for the entire year, and it could be a situation where they're providing for more than half the cost of keeping up the home. The child's lived there for the entire year. They get this special qualification. So it's not just qualifying widow or widower. This makes it a whole lot easier for the title, but it's qualifying widow or widower with a qualifying child. That's our main criteria. So if they have this status, they actually have the highest amount of standard deduction. They actually have a much broader range of the tax brackets. They can earn much more income before they move up to the next tax bracket. Very, very limited circumstance we're going to see, but if they do meet it, we do want to be sure that we can actually have the status qualify. And again, one of the reasons why we want to be sure each year we take a look at their filing status. These will change each year. So you only have a 2-year window to take the qualifying widow or widower. So we'll go ahead and take a break now and take some questions.